This is Trepp Week in Review for week ending May 21st. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is Darren King, Head of CMBS at Trepp. This week, a new milestone. New York City officially reopens and states amp up incentives to push more vaccinations. Meanwhile, the CDC clarifies some mass confusion after their latest guidance. In economic data, quarterly retail earnings strongly beat expectations. Jobless claims dropped again, and more companies are raising wages. Housing starts fell sharply last month, even as home builder confidence held steady. Manufacturing activity slowed slightly with supply chain constraints, and the markets have responded with turbulence. Manus, the minutes from the Fed's last meeting have become something of a meme this week. The policymakers are thinking about discussing tapering bond buying.
That sounds like the kind of excuse I would make early in my marriage when I would miss a train and I'd walk in to the house, smelling of having had a beer or two and trying to explain like what went wrong between 5:30 p.m. when I last contacted my wife and 8:30 p.m. when I walked in the door, right? It was like a start and a restart and an excuse and a fumble. And that's kind of what it sounded like to me. But it was interesting. There's three things that really caught my eye. One that surprised me, another that I didn't understand, and a third which kind of impacts commercial real estate to a degree. So the first one that surprised me was the Fed minutes, where they did have this allusion to tapering perhaps sooner rather than later, right? Early in the week, they were talking about, it sounded like they weren't going to taper for 18 months or 2 years. And then the minutes came out and it sounded like maybe it was going to happen sooner than that. We have said for many pod episodes that the minute tapering becomes a reality, expect bond spreads to blow out, cap rates to go up, and the market to kind of panic. And yet, when this came out, when the minutes came out, what we saw was the market continue a rally, which had started about midday on Wednesday, reversing what had been a vicious sell-off in stocks and crypto. So my surprise of the week was that this event didn't rattle everybody. I thought it would. The other thing that I can't really understand, which seemed to rattle everybody, was this crypto sell-off. And maybe somebody with, Darren or Joe's gray matter can explain that to me. But we saw Bitcoin sell off 30%, which really had people panicking. And the thing that really interested me in commercial real estate this week was that we saw tons of retail earnings, all of which, or most of which, beat to the upside, but didn't result in meaningful upticks in stock prices for retailers this week. So Home Depot, Walmart, Macy's, and then today Lowe's, all really, really surprised on the top and bottom line. But the only one that saw a stock price uptick was Walmart, and even that was modest. Kohl's today was down 10%. So go figure.
I hate to use these cliche words, but it was priced in. Since the beginning of 2021, the back to real world trade has been on, right? So all of the big retailers, the cruise lines, the materials firms and all these other things, like the real economy stocks were winning while the Zoom economy stocks were faltering. So, just like some earnings we talked about in the last couple of weeks, I just think that if you're already up 20 or 30% on the year and then you report great earnings, you don't have much more room to pop. I don't understand the Bitcoin stuff at all, other than the fact that Elon Musk is out there tweeting that Bitcoin is bad. And then he's tweeting that, oh, never mind, we're not selling any, it's okay. That guy's just a Looney Tune, in my opinion.
So what you're saying is it's meeting the old cliche, which is buy the rumor, sell the news.
Yeah.
Right. The talk was all along that the second half of the year, or starting now, explosive retail sales. And certainly some people have been out there really, really talking up what they've seen, right? Simon, we mentioned last week, really, really effusive in what he's seeing. Walmart this week, very enthusiastic. In fact, that's the word they use. Incredible enthusiasm for people coming back to their stores, but investors walking the other way thinking, this trade has run its course and all expectations, as you said, Joe, have been built in.
Was it you last week? Was it us on the Zoom on podcast where you mentioned the Untouchables and the bat over the head?
We did talk about,
I think so.
Enthusiasms.
Robert De Niro. Yes, exactly.
I thought, but I have one other stupid analogy, and then we can move on. So it's almost like, in terms of the Fed minutes. So it's almost like the market is like my 2-year-old son, where he does something wrong, and I sternly talk to him or I yell at him, and I say, I'm going to put you in your room, or I'm going to take that away, or we're going to turn the TV off. And he looks at me, and you could see it in his eyes, and you could just hear him thinking, no, you're not, and that's what the market is thinking. Like every single time we've had any sort of market scare, the Fed has been there to nuzzle us back to sleep, right? And I think that the market just thinks, okay, yeah, talk about, think about, talk about. Let me know when you're actually going to do it. And I don't even believe you're going to do it, because every time you even come close to it, you come back and save us. So it's kind of like, at some point, someone's going to have to take a stand at the Fed and like allow the market to go down without stepping in. I don't know when that's going to be.
Maybe thinking about discussing is like when you count backwards to your 2-year-old. I'm going to be there in 3, 2, 1.
So Darren, you've seen a lot of market dips in your day. What are you taking away from the retail sales numbers and the lack of enthusiasm, if you will, from stock investors from what they saw this week?
I look at it and I think, to Joe's point, a lot of it was already baked in. And I think you're also in a position now where we're coming off a period where you didn't know what the numbers were going to be. Every analyst was just picking a number by throwing a dart at a dartboard. We're coming out of a pandemic, comparing something year over year to the first quarter of 2020 doesn't make sense. Can't compare it quarter over quarter because that doesn't make sense. You're just sort of picking numbers out of a hat as to what quantifies beating expectations or what those expectations are to begin with. And so it's that forward-looking type of view of, can it get better, right? That's, you come in and buy on these earnings if you think it's going to actually get better from here. And again, we've got, to your point, the Fed thinking about, talking about, thinking about indicating to the market that it might do something. You're looking at the stimulus checks actually having now flown through and pass through people's pockets. It's how much more is going to happen here. Are people going to shop in the same way when they're going back to living their normal lives? They weren't going to restaurants. Are they going to exchange the money that they were spending at Lowe's and Home Depot with going out to eat again, which they haven't done in a year? And so I think those expectations for maybe a changing consumer base lead investors to say, you know what, why am I going to add to my investment in these assets at this point in time?
To your point about comparable numbers and what makes sense and so forth. And I read it very quickly, so I may be getting this slightly wrong. But on the one hand, the Kohl's comments today were very bullish. Their leadership was saying, we see the market coming back and we're raising our guidance, we're raising our expectations. And then somebody pointed out, yeah, but even with you raising your expectations and you painting a really rosy picture, your numbers are still below where they were in 2019. So in some ways, from their perspective, this is a heroic comeback, right? From leadership, from where we were. But the bear case is, even with your really enthusiastic, forward-looking expectations, you're still trailing 2019 numbers at the end of a best case scenario that you're presenting for us.
We should just change the name of this podcast to Kohl's Update Weekly. I don't think there's any other podcast in the United States or the world that mentions Kohl's every single episode.
Yeah.
If you hear me shuffling through my papers now, it's a reminder now to look for my Kohl's Cash coupon that came in the mail
I
today.
hope you're compensated for this. Yeah. So at the beginning of the week, AT&T announced that it was spinning off WarnerMedia into a new company to be merged with Discovery. And this latest installment in the streaming wars is something that Darren has done some analysis on and the impact to real estate. So Darren, why don't you walk us through what you call the Amazon effect for the movie theater?
Yeah, initially I kind of used that as a metaphor until a day or two ago when it became literal, when the news started to come out and the story started to get written that Amazon was actually looking at buying MGM potentially, and going from the sort of metaphor of the e-commerce Amazon effect of what streaming could do to the bricks and mortar movie theater to literally what Amazon Prime in buying a movie studio could do to AMC, Regal, Cinemark. So yeah, we were looking at this. I started actually thinking about this really at the beginning of the year when some of the bearish websites, the Drudge Reports and the like, started posting a chart that showed movie ticket sales just falling off a cliff in 2020. And I kind of looked at that and was like, interesting. Does this have an effect? Is it maybe a little bit hyperbolic? Of course, movie theaters were closed for the majority of the year. This really isn't saying much about what may happen with vaccines and everything coming back. But then you start to see more headlines come out about how the theater industry and their relationship with the movie studios was dramatically changing from what it had been pre-pandemic. You look at just about every studio now has its own streaming service, with I think MGM being one of the last ones that doesn't, and maybe not for long. But they now have this platform with which to go direct to consumer via streaming, whether it's part of the Disney Plus package or whether you have to pay an extra $20 to see the movie, but to go compete directly with the movie theater. Historically, the theaters had about a 2.5 month, what they call theatrical window, which is the amount of time they get to air the movie and it doesn't go on demand in any form. Like if you go back years, you think about DVDs or Blu-ray. Fast forward, you're thinking about release to Netflix or or on-demand cable, things like that. It's 2.5 months. Now you've got a number of deals cut in the last month or two between the studios and the theaters, shrinking that theatrical window to 45 days down to 30 days. So the amount of time they get that sole right to air these films has shrunk, certainly potentially cutting into their box office take. Goes even further with a couple, I think NBC Universal negotiated a deal where they have an option to pull movies in as short as 2 weeks. Take it a step further, you've got Disney coming out and saying that we're going to take some of our movies and stream them simultaneously on the same day they hit the theater, giving consumers a choice, like sit on your couch and watch it or go to the movies. And even if you don't believe that the movie theater as a whole is going away, you're introducing this same e-commerce digital effect of you can now make it much more convenient for someone to consume this media content at home in their pajamas from the comfort of their couch, or pause it, let their kids run around, blow off some steam, come back and continue to watch the movie. And so you kind of look at this now from a real estate perspective and sort of how pervasive is movie theater in the real estate market. And the numbers are actually pretty big. So you've got in the country, and this is pre-pandemic numbers, about 5,500 physical movie theater locations. These are indoor ones. There's a few hundred outdoor drive-in things that also exist, and 40,000 movie screens. So pretty significant real estate footprint. And where are these things located? The same places that the real estate market is struggling with right now, which is in major urban and suburban power centers, and of course, regional malls, right? These are the prime locations where you're seeing these movie theater sites. And so now you've got this new effect, and if you're out there believing that the entire industry is going to get eliminated, that's a super bearish viewpoint. But even if there's just some now knock-on effect that, okay, some of these 40,000 screens have to go away, the places that are going to affect are your regional malls. We also kind of dug into the CMBS data for this as well, and kind of found over $23 billion of collateral where a movie theater is a top 5 tenant. That was over 300 different loans in over 250 deals. And these are generally, again, because they're usually regional malls or large shopping centers, top 10 type loans. So pretty significant exposure to the real estate space and to the CMBS space.
Darren, when you mentioned Disney putting their movies straight onto Disney Plus, that one to me is the most relevant, because an adult seeing a movie like, an R-rated or a PG-13 movie come out in the theaters, I think there's still always going to be some segment of the population that still enjoys going to the theater. I mean, maybe I'm biased because I grew up going to the movies, but I can promise you this, that if I have the option to watch the movie with my kid at home, where I have the diaper table right over there, I've got toys over there, I've got all sorts of facilities that I can use to manage this kid versus bringing him to a public place where it could be potential mayhem, I'm definitely keeping that kid home. But I think the other funny part about your analysis that I thought was that the number one theater operator in CMBS, and correct me if I'm wrong, but based on what I was looking here, was AMC. And they're also the meme stock that has been able to kind of stay alive thanks to their stock price getting pumped up to oblivion and then them selling shares and raising capital and stuff like that. So it's kind of funny how all this like new world, media and everything else is attacking brick and mortar media, I guess you could call it, but also keeping it alive via Wall Street bets.
Well, it's interesting. I have two thoughts on this, and one's a question, and one's more of a thought. Darren's riff in the beginning about, people streaming all the time and watching first run movies. Joe's a big movie guy. We're on Zoom calls all the time, and I watch him getting distracted. And I'm always looking for the reflection in his glasses to see if on his second screen he's watching King Kong versus Godzilla or something else. I'm trying to get that reflection.
Oh my God, I wish.
Because I know you're a two-screen guy. And I'm thinking every time, those eyes tilt 45 degrees to the left or right, I'm thinking, you're not listening anymore. You're watching a first-run movie. But going back to Darren's analysis.
That's the pot calling the kettle black, by the way, just saying. Manis only listens to about 4% of what I say.
To Darren's point, movies are a kind of unusual space within a mall. What kind of revenue do they generate for a mall? What kind of lease? Are they comparable to a Macy's or a Sears? They're comparable to a smaller version of a Best Buy or a Victoria's Secret? What is their status in a mall from a financial point of view?
Yeah, man. So that's a really interesting point, and something that the real estate markets and CMBS investors out there, I think, should be thinking about as they consider whether or not these theaters are going to downsize, close locations, because I think the nearest comp for these is I think you put it perfectly, kind of between the Best Buy and the kind of department store anchor. So you look at when we looked at this anecdotally in the CMBS data set, on average, the percentage of the gross leasable area that the movie theater takes up is somewhere in the neighborhood of 15%. So it's a big tenant, in the space. And again, we're looking at loans where it's rated as a top 5. So you kind of put it in that kind of department store-ish type of category in terms of the size of the square footage. Now it's smaller than a JCPenney, which would probably usually be a 20 to 25% the gross leasable area. But then you kind of get to, Matt, the point you made, which is the revenue side of it. When you have JCPenney or the old Bon-Ton or Macy's, these are tenants generally paying $3, $4, $5 a square foot. So if they've got 150,000 square feet and they're paying $4 a square foot, they pay $600,000 of total rent for their 25% of the entire physical space. The movie theater may be half that in terms of physical space. Maybe it's 60 or 70,000 square feet, but at the same time, it's going to pay 2, 3, 4 times the amount of total rent that JCPenney's is paying. So while it's a smaller physical footprint, it's a much more significant revenue footprint. So if you're a landlord and owning this thing and you're looking at it and say, okay, I've lost my JCPenney. Okay, that hurts. We've talked, many times about the co-tenancy relationship and what happens with the smaller tenants when your department store leaves. But we don't talk much about, the actual revenue loss and the hit to, operating income when you lose that JCPenney, because it's pretty insignificant. Even though it's 25% of the physical space, like I said, it's 4 or 5% of the actual revenue. When you go to the movie theater, you're talking about, 12, 15% of the physical space and a similar percentage of the actual revenue. So you really have a much more significant immediate hit if that movie theater decides to leave. The second piece of it is the co-tenancy relationship, which actually can exist also for the movie theater. And this is interesting because a lot of landlords pre-pandemic wanted the movie theater to be in that co-tenancy conversation because they viewed it as a very sticky tenant. This was a stable performer. They pay real rent. It's unlikely that they're just going to pick up and move to another location. because of how specialized the space is. So if you can include that as a co-tenant, in a lease with a smaller inline, negotiation, you figured you were in better situation than having just JCPenney and Macy's be those co-tenant anchors. Which leads us to sort of the third piece of this, which for me is what happens when the movie theater does go dark, when they do vacate. And now you've got what made them a good tenant because they were sticky because of that specialized space makes them a horrible dark space. When they leave, who's going to take that over? We've seen reports and kind of, I've actually dealt with this a little bit with brokers, that once a movie theater goes, if you can't replace it with another movie theater, you pretty much have to take that space down to the foundation and start from scratch and actually take it beyond the foundation, because the actual physical slab of a movie theater, if you think about the construction, is actually slanted. So you've actually got to dig up the foundation and literally flatten the thing out before you can actually even do anything for a new tenant. Whereas even when that JCPenney's goes dark, you've got a nice blank, big open space you can do a lot with.
My scarring story about the alternative use for the movie theater came when I was just a pup. I grew up in Suffolk County on Long Island when it really wasn't very heavily developed. There's still a lot of farmland out there when I was a kid. And the first church my father took me to out of Long Island was held in a movie theater. So you talk about the negative bait and switch, that we would pull into this parking lot, sometimes on the Saturday night service. So you're walking into this place at 5 o'clock at night and you're thinking, this is going to be great, right? We're going to watch, a few cartoons and then, a rated G movie, some Disney thing. You're getting ready for the popcorn. And then all of a sudden they spring it on you that this is no movie. This is fire and brimstone. And, you're going to sit here patiently for 45 minutes and not say a word and learn something. So that was my negative alternative use story about movie theaters from growing up. The Fox Theater in East Setauket, Long Island on 25A.
I have to give one shout out and then we can move on. During Darren's presentation of some of this material to our internal team, I got a message on Zoom from Peter S., who said, you can use them for schools. And he said, see, I am listening to the podcast. So good job by him. They would be a weird school. It would have to be a school that has like 4 massive lecture hall style classes going on at once. And then you just kind of go and get some popcorn in between.
Is it the reclining movie theater, the one that you can lay down and listen to the professor or teacher?
That's what it is right now on Zoom.
Well, those are less likely to go out of business. I think that's actually a good segue. I painted a pretty negative picture of this. I want to kind of feel a little bit balanced in that this is actually a pretty innovative industry. I think going back to about 2014 or so, between AMC, Cinemark, Cineworld, which owns Regal, they've spent about $1.5 billion to $2 billion in CapEx to sort of renovate these theaters, pull out those old style seats, put in the luxury recliners, and in doing so, they actually remove on average about half the seats when they do this. So an industry based around how many tickets you sell, someone somewhere had this amazing idea that we're going to take out half our seats and make more money. And they did it, and it was, up until the pandemic, it was actually working. Even if you see graphs of kind of ticket sales, either flat to even slightly declining over the last few years, the actual revenue from the theaters was increasing, and not so much because ticket prices were going up, but because people were actually going to the movies and buying all the other things. So I don't know that it's a situation where, this is the end of the movie theater. I think it's revamping of their process and their business model to a certain extent, and maybe trying to find some alternative uses for what they can do inside the theater. But they've been innovative in the past, and I wouldn't completely count them out, in the future of figuring out how to combat at least some of the Amazon effect that, that's certainly going to happen from the streaming.
Don't forget, if you're going to the Alamo Drafthouse or one of these movie theaters that's like a restaurant, if you don't get there 30 minutes before the movie and get your order in, you are going to be 45 minutes into a movie starving and ready to kill somebody, because you're looking to your left and to your right, seeing people chomping down on popcorn and hot pretzels and burgers. And they have to put 30 meals or 40 meals together all at once because everyone shows up at the same time. If you don't get in that first wave of orders, like you're in for serious trouble. Just a PSA there.
So we'll be releasing the details of Darren's report next week. So if you want to see this in more detail, check out our website next week. Turning to a trading alert that we had this week that was particularly focused on a mall that we've talked about numerous times.
So this was interesting. This is all about retail this week, right? We talked about earnings and then movie theaters, and now we're on to CMBX 6. So the story at hand was, and it has been for a long time, that back in January, the Prism outlet malls in Las Vegas were sold at auction for about $1 million, $1.5 million. That was a big headline in January. The mall had once backed a $73 million CMBS loan. The mall itself was $125 million in valuation back in 2012. The loan resolved this month. The liquidation proceeds totaled only about $400,000. There were liquidation expenses of, I believe, $12 million. So when all is said and done, there is $12 million more in losses, money that has to be repaid, servicer advances and so forth, than was recovered on the loan. This wiped out classes F and G from the COM 2012 CR4 deal, and about 2/3 of the BBB minus Class E bond, and there's still $11 million in losses still to go that haven't been reflected in the bond waterfall yet. So we put out a headline in our daily trading alert, which said the day of reckoning came for this mall. One listener and one reader of our daily newsletter came back and they took the alternative point of view. Part of our story said this was a great moment, a victory lap moment for CMBX 6 shorts, people who had bet against the malls and were expecting big losses to come out. This person said, I'm going to take the contrarian view. And here was his point of view. And he said he has been long and short CMBX at various points in the curve. So he says, I'm talking from experience from both a long and a short point of view. And he says, I'm going to take the contrarian point of view. And his point was, even though the size of the loss was epic, this was a dead loan walking for a long time. This was a known problem as early as 2019, maybe even earlier. People were expecting a minimal recovery on this. And the thing that would make him nervous as a short would be the fact that it took till the middle of 2021 for this to be resolved with this loss. And his point was, and I'm not endorsing it or challenging it, either one, but it is a point of view that is on the other side of what we usually talk about, which is that if it takes this long for a dead loan walking to be resolved, then it's going to take a lot longer than people think for all these other malls that were securitized in 2012 and 2013 to play out. And the carrying costs are going to really add up for the shorts, and the longs may get the last laugh, right? If it takes till 2025 or 2026 for these other less undesirable malls to resolve, then these longs could be money good. And with that, let me open it up to Darren and Joe for their thoughts on this, because I thought it was an excellent point that was made by the listener.
Yeah, I think, we talk about this type of stuff, well, because it's interesting, but also because a lot of the market, watches this. And whenever anything is branded the next big short, it's, it gets a lot of attention. So we have to kind of talk about it to keep our listeners in the loop. This particular loan had been delinquent for, I think, 43 months, so almost 4 years. So he has a point there. That took a really long time to get liquidated. I do find it interesting that, there's another $11 million or so that needs to kind of flow through the waterfall. So that'll, I don't know how exactly that'll happen. I'm sure it'll be over the next several months or something like that. But it's really hard to say if you don't know the details of the trade, right? I mean, if you're getting paid 2,500 basis points annually on a large notional value, and you get paid that for 5 or 6 years, that's a pretty good chunk of change that you make before you ever have to pay anything out.
So I'll take the hedged viewpoint and both agree and disagree with different aspects of it. I think from that listener's perspective, I agree that time is obviously the enemy of the shorts with these trades, and even extensions of loans at default at maturity work against the shorts. Where I'll take the side of disagreeing is if the loss is big enough, the time isn't going to matter all that much, right? This loan is this loan we're talking about in COM 2012 CR4 is a perfect example. It took 43 months to go from delinquent to disposed of, but it didn't get down to a value that was ultimately a liquidation proceeds of $400,000. It kept going. It actually kept getting worse and worse and worse. If you look at the appraisals of it over time, and not that the appraisal would ever result in the final sale number, it's what someone's willing to pay for it. But this asset didn't go from an appraisal of $126 million to a $400 or to $1 million value. It sort of scaled its way down, and then the pandemic obviously made things even worse. But you have that perspective of that extension of time may actually have ultimately increased the loss. Where I also kind of look at this as a cautionary tale in terms of, if this mall took this long to get disposed of, all the rest are, going to take a really long time, is, we're talking about that there's still $11.5 or $12 million that the servicer has to continue to recoup from this because they over advanced. Now, no one thought it was going to be worth $1 million. I don't even think the shorts did. But the fact that they over advance and now have to recover it after the fact, and it's taking more than 100% loss, is in part due to the amount of time it stayed outstanding. Servicers are probably going to be more apt to liquidate these malls faster because they don't want to wind up in the same position. They don't want to wind up with a situation where even if the mall isn't going to be 120% loss, they don't want to even come close to these situations where they build up $5-10 million of advances, over time, and then have that eat into the liquidation proceeds. I would imagine they're going to look at this and be like, shoot, we've got to get out of these things quicker to avoid this kind of a mess in the first place.
There is that notion with the mall space that your best loss is your first loss, right? We've seen this even before COVID. We've seen this for 15 years, stories of malls, $100 million in debt, $50 million valuation. When it first goes delinquent, then 40, then 30, then 20, and then it's liquidated at 10. So you're absolutely right. There's a long history of this, and this particular story may move special servicers to move more quickly to limit this. I'll bring up 2 other points on this particular story before we move on. For those people that are not involved in CMBX, but are traders of this particular bond, right, the P&I versions of this bond, what you need to know right now is that what will happen in the future is, or for what we think, is that the servicer is going to take their proceeds back, $11 million back, out of principal. That's what they did this month, to the tune of $1 million, out of first pay cash. So you could see an actual slowing down of the return of principal for the first pay bonds for the next several months. So, if you're trading those kind of bonds and you're not really sure what this means, you should hop on the phone with us if you're a client and get one of our bond finance guys or Darren on the phone to talk about what this means for you as an IO holder or a first pay guy. But to close the loop on this story in another way, just a couple of other points on this. The 3 different loans came up in our Trepp wire service this week that all were of a similar note. The Newport Center loan, it's a $168 million loan that makes up 83% of a 2011 deal backed by a loan in Jersey City, New Jersey, a super regional. It did not pay off this month, even though it was recently valued still at almost double what the loan balance is. So this is not a CMBX 6 loan, but it does show that sometimes even really strong performers get to their maturity date and don't have refinancing in place and take a little bit longer than you would think to pay off the loan. In this case, there's still a 50 LTV based on a JLL valuation from October 2020. So this is one of those things that would kind of stick in the craw of shorts as a negative trend. Another one, a similar story. This again backs a 2011 loan, a $121 million note. The Ingram Park Mall, that's in San Antonio, Texas. The borrower indicated they would not be able to refinance the loan when it matures next month. They're looking for an extension. Hopefully, in their case, they're looking for something in the 3 to 5 year range. Again, something that would accrue to the detriment of CMBX 6 shorts. And then lastly, we had the Arbor Walk and Palms Crossing. That's a 465,000 square foot property in Austin, Texas. That again was sent to special servicing in May. The loan is expected to mature in August 2021, and the special servicer workout strategy code has been sent to extension. So it looks like they're weighing whether to give the borrower an extension there. So those are 3 stories, one after another, that would kind of underscore this lengthy extension. It's going to take a while narrative, that this listener was talking about earlier this week.
So turning to office, this week we had an interesting community call with a couple of panelists from a combination of industry and academia, which our own Joe McBride moderated. Joe was very well done, interesting and engaging. There are a couple of key takeaways, and obviously we will make that recording available to listeners. But I thought one of the interesting takeaways from Ryan Severino, who's actually been on our pod, he's an economist with JLL, that generally young people that work in these cities that have been very quiet with low occupancy, these are folks that don't want to work in their small, expensive apartments. They're looking to go back to the office.
Yeah, I love Ryan. He's like a common sense economist. There were a few takeaways from this, and I think the best type of economists and prognosticators are the ones that understand that they really don't know anything about the future, but that they can kind of tell a good story and back it up with reasonable data. But a couple of the points that did come up. One is that, which I never really thought of before, but Dr. Glenn Mueller, who's a PhD kind of economist who's been studying the real estate market for a really long time out in Denver, he said that office employment, meaning like the types of jobs that are done in offices, is only going to accelerate in the next 10, 15, 20, or forever, really, right? Like with tech and everything being digitized and everything like that, that there's going to be more and more jobs that require kind of computer work, and that still a lot of that work is going to be done in offices. So his line at the very end was, office employment will accelerate, office use will moderate. So I thought that was a good takeaway. I also thought, a couple people pulled out the 9/11 reference, which was that, post 9/11, everybody said no one's ever going to rent any office space, in high floors of towers. And that really wasn't the case after a year or two post 9/11. And I think, the short memory aspect here is very possible. Recency bias is a real thing. And we all think that how we're living right now is going to be the way we live forever. And that's rarely the case. So it's very possible that, 2 years from now, we look back and say, can you believe we thought we were never going back to the office? And most people are back. So, and I guess one other takeaway from that was that it goes back to our very early podcast episode. So for our very loyal listeners who've been here from the start, the haves and the have-nots, that the B and C office buildings built in the 50s and the 60s that haven't really been, fully renovated or fully brought up to speed on HVAC systems and open office space and stuff like that, they're going to really struggle coming out of this, because if companies are planning on attracting employees back to the office, they're going to have an attractive office to bring them back to.
I thought it was an interesting week of headlines in the office space. Some good, some bad. I'll start out with the discouraging side of things. CNBC early in the week, I thought this was a really interesting report. They were talking about all of the San Francisco tech companies that had put their space up for sublet, and the sheer number of impairments they had taken, financial impairments, for space that they will have to pay for but will not use, right? It is now negative equity, if you will, or negative arbitrage on these leases that they're accounting for today. There's a great graphic that I have a copy of. I don't know if I'm free to send this around or not, but you could also find it on CMBC. But listen to some of these impairments over the last few months. Dropbox, 416 million that they've written off because they're not going back to office. Salesforce, 216 million. Airbnb, almost 150 million. Uber, 94 million. PayPal, 44 million. And there's several others on these lists, all of which have more than $10 million in impairments. And if you're going to go to the effort of kind of recognizing these as losses, it kind of goes to show that you're probably not going back, right? Why would you do this if you thought that there was a chance that you might reverse course and actually keep your people in the office? That was the discouraging signs of the week. I did have several encouraging signs. There was a headline from Globe Street this week that KPG plans to acquire over $1 billion in New York offices and New York retail real estate. Those are, the retail space we've said has been a real question mark in New York City, but they're diving in with $1 billion checkbook. And offices, that's another place where nobody really knows where that's headed, but they're putting their money where their mouth is. This one from Commercial Property Executive, the Paramount Group plans to invest $250 million in 60 Wall Street. Old-time CMBS investors will remember that was the office solely occupied by Deutsche Bank. Deutsche Bank is leaving. That building will soon be completely vacant in Lower Manhattan. The fact that Paramount's going to pump in between 200 and 300 million there is a real vote of confidence that Lower Manhattan will come back in force and they'll be able to put this space back to work. That one is interesting to me because while tech firms have gravitated to Manhattan, they haven't gravitated toward Lower Manhattan. It's been all Hudson Yards and the Chelsea area. So this is a big bet being made by the Paramount Group. And we did see a couple of big leases this week, which we thought were terrific. One is law firm Snell and Wilmer. They're going to take 115,000 square feet at Cityscape in Phoenix. That will take that building to 98% occupied. It does back a big 2014 CMBS loan, $172 million loan to that effect. So it was a real big loan there. We also saw one this week that IBM was going to take a huge swath of space in Lowell, Mass. This is space that was previously occupied and later vacated by Verizon in that city. So while there are some discouraging signs with the impairments, a lot more positive signs this week of people taking space in various markets around the U.S.
So I should just mention on the positive side, and it's a very minor positive, we have started to see some headlines and some research out of some of the big CRE brokerage firms saying that sublease space may have plateaued. And especially in Manhattan, I was looking at a Newmark research that was sent around a week or two ago that we've had a couple of weeks in a row of total sublease availability decline. So there are some firms taking space off the market, and I'm sure some other firms actually taking up some of that sublease space. So that's a good sign. I hope that continues.
Looking at hotels, Mayor Bill de Blasio signed an executive order eliminating New York City's hotel room occupancy tax for the summer in an effort to jumpstart the recovery of the hotel industry.
I mean, it is a big, big number. Let's not kid ourselves. I think the nightly tax is 13%, if I'm not mistaken. And if you're paying $400 a night, for a hotel room, which I don't think people are paying that now because I think the market is struggling. But at the peak, if you're paying $400, $500, $600 a night in New York, that's adding, $60 or $70 to your tab. That's a big number. And if you're saying 3 or 4 nights, that really adds up. So the mayor is not somebody who gets a lot of kudos. I think he's mishandled a lot of things over the course of the pandemic, but I do think that this is a really, really good thing to do for a city that needs to get people starting to come back to start going to Broadway shows and games and restaurants and so forth. And while we're on the topic of good decisions, I saw the Mets this week will not need somebody to show a negative COVID test if they haven't been vaccinated. They're just going to let the floodgates open. People are going to be able to come in and good for that. I had to get a test last time I went to Citi Field a few weeks ago. And I'm pretty sure that the woman that administered the test was formerly, perhaps in interrogations, maybe in the Middle East somewhere.
I think she was in lobotomies.
Yeah, I don't know what it was, but she really got up there.
I have no response to that. Well, I will say Donut Shorts, we always mention him. He was tweeting a bunch recently, yesterday or the day before, about another side of the coin on de Blasio and hotels, that he's pushing to add another layer of bureaucracy or city council approval in order to build new hotels. So that was negative, at least by Donut Shorts' standpoint.
I'll give another one, which I liked as well this week. This also was from Commercial Observer. I'm trying to think who the hotel group was. A new Marriott is going to be built in Southern California, which is great to see somebody kind of diving in and starting a new project at a time when you think there's probably a glut everywhere right now. So another green shoot there for a hotel market that has had a rocky 14 months, but hopefully we're coming out of it. That was the Hotel Investment Group, by the way.
Yeah, and just the last thing on hotels here, I'll give a shout out to Eva Steiner, who is an associate professor from Penn State, who we had on as a guest this week. I think we're going to be releasing that podcast next week. She was really great. Some really good insights into hotel performance and PPP and some other things, and just like a very energetic person to listen to. It was great. I should also give you guys a retroactive plug for the Jim Shevlin interview. He's the president and COO at CW Capital, and who's a big special servicer. And so, we get some insight into what they've seen. So I think we're going to get a lot of plays on that one, because everyone's always trying to get in the mind of the special servicer.
Well, we did talk about some of these alternative tenants on that podcast, and there was a couple of humorous moments with us peppering him with questions on whether or not he would approve as a special servicer a lease to an unusual type of tenant. So we'll put that little Easter egg in there for people to look for that one.
And we released first quarter data, what is called LifeComps data, which is commercial mortgage investments held by life insurance companies. Joe, just give us a quick hit on that. We're going to have that actually available on the website for people that want to read it in detail.
Yeah, so first quarter 2021, this is basically returns on life insurance balance sheet commercial real estate loans. We actually had a negative, about 80 basis point quarterly return, and that's different, or that's the first negative in several quarters. So they break it up between appreciation and value and income, and the income was positive, but the appreciation and value was negative, probably due to interest rates rising slightly. So definitely take a look at that. It's very interesting data for our balance sheet lenders who like to be able to benchmark themselves against the broader market, and also find what the heck discount rate should I be using when I'm valuing these loans on my balance sheet.
And turning to shout outs for the week, Matt O, who's a repeat shout out candidate person.
Shout outie.
Shout outer, I don't know. He actually liked the community call discussion that we were just referencing earlier, and wanted to get some of the information. There was some really good economic data at the beginning of that call, and that was what he was referring to. A Trepp alum, Mark Meering-Smith, sent a Financial Times story about, if you recall, I think it was last podcast, we were talking about the food and energy prices in inflation being excluded. And he suggested that perhaps the writers of that article were copying us after having listened to the podcast. So who knows? It's hard to say. Hello, this is his favorite podcast, or her favorite. I apologize. I'm not sure, but it's a favorite. Reached out to mention a comment about the 1031 conversation. We've had a lot of people talk about that. So I think we'll do a repeat performance on covering both the pros and cons for that. And obviously, Real Insight and Real Insight Marketplace and CW Capital that we were just talking about, that podcast, they shared the episode with their listeners as well. So thank you for doing that. And then to wrap it up, a story that I thought encapsulated our time. An Airbnb user claims that she found an abandoned shopping mall under her apartment. Claire Shulin, who rented an Airbnb unit, posted the exploration of her findings on her TikTok channel. She and a friend walked into the closed retail space and shot a video, posted it on TikTok. It was viewed 7 million times.
The most unusual thing I found in something that I acquired was I had bought a house in Westchester, New York in the 1990s. And after closing and coming home, I found somebody living in the basement. And when I went down there, I said, what are you doing here? And he goes, oh, I was just leaving. And he rolled up a sleeping bag and walked out the front door, never to be seen again. But that was, quite an unusual turn of events after thinking we had sole possession of the home.
Oh, I don't know if I could top that. We might have to end on that one, but
that one wins.
I would just say that, 7 million views on a video of kind of an abandoned mall. I mean, if I'm a B or C mall guy, I might just kick all my tenants out and start charging like $50 a head for Instagram and TikTok influencers to come take pictures. Maybe put one of those like butterfly wing things on the wall, something like that.
I'm just keeping my fingers crossed that malls don't get so lowly valued that I start giving them away and, for Christmas gift.
Listen, this mall owner, he's got a non-fungible token opportunity here. He's smart, so that's what he should do. With that, we'll close. Thanks to our producer, Haley Keene, and thank you, Darren King, for joining us this week. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email to podcast@trepp.com. Visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.